I'd like to thank everyone for listening in. This is a presentation on Social Security. With us today is myself, Seth Meisler. I'm the Chief Investment Officer at Affiance Financial, as well as CPA and Certified Financial Planner, CFP. With me is
Omer Abramovich, been at Affiance Financial for 2 years now. Official title is Associate Financial Planner. We've been primarily working with Steve's clients, and my colleagues refer to me as the quarterback of Steve's team, making sure that clients' relationships are being maintained to the best way possible.
Over the last several years, Omer and I have spent a lot of time really learning about Social Security, reading the books, meeting the people who are a lot of the thought leaders nationally with regards to Social Security, as well as working with a variety of software of Social Security planning tools, including at one time building our own. So we have a lot of experience working with Social Security, and we'd like to share that with you today. If you think that Social Security is complicated, you would be right. It is very complicated. There are literally thousands of rules, and making the wrong decision, you can lose literally hundreds of thousands of dollars. No exaggeration. We do want to repeat that this seminar is purely educational. We are not giving specific advice in this seminar. Every situation is different, so the advice is general in nature. We would suggest that you talk to us with regards to your specific situation so that we can look at the detail. We're going to start with a little video with regards to Social Security that is from T. Rowe Price.
So in order to start a conversation and get us going today, we got to talk very briefly about some of the history of Social Security. And the first thing to address is the Great Depression. That was the kicker that started the conversation. We're all familiar with the fact that the stock market crashed in 1929, more than 40%, extremely high unemployment rates, above 25%. Many banks failed, and millions were in poverty and out of work. Out of those millions, 50% of all seniors in the U.S. experienced some poverty.
There are many ideas about how to deal with senior poverty, and some of the most well-known ones were by Huey Long, which was basically a share of wealth plan. giving families grants of $5,000 and also income of $2,000 to $3,000 annually. And that received some support, but not a lot. 1 year earlier, Dr. Francis Townsend proposed a pension plan, which was given to every citizen over 60 and funded by a national sales tax. And that got quite a bit of support, 2.2 million supporters.
In 1935, Social Security was signed into law. That wasn't without its fair share of criticism, of course. Back then, Thomas Gore, a Democrat from Oklahoma, in an open letter to Francis Parkins, who was head of the Department of Labor, referred to the Social Security Act as socialism. He was very, very concerned about it. But it was assigned into law, which was a good thing. Some of the first provisions were benefits to retirees that included a lump sum in the first year and the unemployed. Back then, there was 2% tax on current workers' wages. Keep in mind that today it's closer to 10%. And back then, the idea was that individuals will be able to start collecting at age 65. Keep in mind that back in 1935, the average life expectancy for the average American was 60 years old. So the idea was that most people will not even be able to collect those benefits, and those who will probably do it for a very limited period of time.
We want to first take some time and talk about how Social Security works to set the stage. And from there, then we'll get more complicated in terms of strategies with regards to Social Security. Okay, so when you work, you pay Social Security taxes on your earned income. Each year you work, you're eligible to earn up to 4 credits or 1 credit per quarter. You are taxed on your earnings, which is FICA tax, which is 6.2% of your earnings up to roughly $118,000. Your employer pays a match of that 6.2%. There's an additional tax for Medicare, which is 1.45%, but we'll leave that to the side for right now. If you are self-employed, you would be paying both the employee and the employer. Again, you can earn up to 4 credits per year. In order for you to be eligible for Social Security benefits, you must earn 40 credits, equivalent to 10 years of work. Now, you don't have to work 10 years in a row. It can be breaks over your working lifetime, but it does need to be a total of 40 credits. If, let's say, you earn 39 credits, you work, in other words, 9 years and 9 months, you are not eligible for Social Security benefits on your work record. That does not mean, however, that you may not be eligible for Social Security benefits on someone else's record.
So let's talk a little bit about some of the fundamentals that go into Social Security. So you're going to hear Seth and I using PIA and SSA throughout this presentation. PIA basically stands for primary insurance amount, which is the amount that an individual receives at a full retirement age. SSA stands for the Social Security Administration, which is the organization that calculates your PIA, primary insurance amount. There is a complicated formula that is being used to calculate the PIA, but it is based on the 35 highest earning years. Timing of when to apply for Social Security benefits is a key. We're going to talk about it at length throughout this presentation. And then Seth and I found out that you can go to this website, socialsecurity.gov-estimator, if you really want to know what your retirement benefits are going to look like. Keep in mind that there are a bunch of calculators on the website, but we found that this particular one is a pretty good starting point to begin.
So, Omer, can I ask you, you talk about the calculation is based upon your 35 highest earning years. What happens if you only work 20 years?
So that's a great question. If you only work for 20 years, the extra 15 years will count as 0 as your earning record. So clearly your benefits will be reduced.
Okay. Well, what about the fact that, let's face it, what people earned 35 years ago is quite different than what people earn today? And so obviously the salary amount, again, for similar work today and 35 years ago is quite different. Does Social Security factor that in?
Yes, so that's another great question. So yes, they do factor it in. Those wages are indexed for inflation up to when an individual reaches age 60. So as Seth just mentioned, $50,000 back in 1960 is not equivalent to $50,000 in today's dollars. So yes, it is indexed for inflation up to age 60. The full retirement age, we have a table that shows, based on your age and when you were born, what your full retirement age is. If you were born after 1960, like Seth and I, right now your full retirement age is 67. Between 43 and 54, your full retirement age is 66. And then from 54 to 60, it just goes up by 2 months up to age 67.
Well, the PIA amount is at your full retirement age, which is either 66 or 67 or somewhere in between. That doesn't necessarily mean that you need to take it at your full retirement age. You can take it either earlier, as young as age 62, or later as age 70. Now, clearly, you could take it after age 70 if you wanted to. However, there would certainly be no benefit to you to take past age 70. The amount of Social Security you receive, though, is different based upon the ages that you take. In other words, assuming that your full retirement age is 66 and you take Social Security early, the amount of Social Security you will receive, that monthly benefit, would be reduced up to 75% of your Social Security if you're age 62. Conversely, if you wait till age 70, the amount of Social Security benefit you will receive will increase by 8% a year, up to 132%. So, for example, if you were to receive, let's say, $1,000 a month, as again a hypothetical example, at your full retirement age of 66, were you to take at age 62, that amount would be $750. And would you wait till age 70, the monthly amount you would receive is $1,320. So a pretty wide spread, obviously, between $750 per month versus $1,320 per month, simply by waiting. Social Security does increase the monthly payment by inflation, or by what they call the cost of living adjustment, or we call COLA. Between 2000 and 2015, the cost of living adjustment was 2.43% per year. The 2015 adjustment was 1.7% increase in the monthly benefit for Social Security. Social Security has announced their increase for 2016, and that increase will be zero.
So what we want you guys to glean from this slide is that the decision of when and how to collect your Social Security benefits is not just dependent on you. There are other groups of people that can be highly impacted by your decision making. Those groups are your spouse, it can be an ex-spouse, it can be your children, your grandchildren, and even your parents.
The Social Security rules get significantly more complicated if you have what we call the 3Ds. So divorce, death, or disability. If any of those situations, or a combination of those, is in your personal situation, the rules get significantly more complicated, and the strategies get more complicated as well. You are able to take benefits off of ex-spouses or ex-deceased spouses. Again, disability rules are really specific for children with disability, adults with disability, or even parents who are dependents in your household. Also, the rules get complicated if you are working and receiving retirement benefits. Specifically, if you are under your full retirement age. So we're talking about 66, 67, or somewhere in between. If you are working and you are under full retirement age and you are receiving Social Security benefits, $1 of every $2 you earn over the earning limit, which is $15,720 for singles, will be withheld by Social Security. If you are in full retirement age, then $1 out of every $3, again exceeding a specific limit, will be withheld for by Social Security. Now, don't worry, just because it's withheld doesn't mean that you won't receive it. You will receive that money after full retirement age. Once you are over your full retirement age, then Social Security will not withhold any benefits. However, that doesn't mean that you won't get taxed on Social Security. So if you have income, and it could be earned or unearned income, including municipal bond income, your Social Security is taxable if it's above specific limits, which are $25,000 for single and $32,000 if married, and again higher. The taxable amount can be up to 85%, and again depending upon your specific situation.
So Seth talked about some of the factors to consider of the timing of when to collect benefits, and he did talk about work. Just to reiterate, please be careful if you want to collect your benefits prior to your full retirement age and you're still working, just know that it is going to be taxed. Another thing is effect on future widow and widower benefits. Please remember that upon the death of a spouse, the other spouse will be entitled to receive what's called survivorship benefits. These benefits will be determined on what age and the timing that the deceased spouse elected to receive those benefits. So there's a huge impact on, widow and widower benefits. Personal finances, you probably hear out there, hey, the more you delay your benefits, the better you might be, which is the truth. However, we all have our each unique situations. Some people cannot wait. They have to take it at age 62. Just know that those benefits are going to be reduced. Expected lifespan, if you're planning on delaying your benefits and all of a sudden you are diagnosed with terminal cancer, just use common sense. Start collecting your benefits now. And then coordination of spousal benefits. Remember that it's not just a spouse. It can be an ex-spouse, it can be a deceased spouse, and it can even be an ex-deceased spouse that is involved in the coordination of those spousal benefits.
A lot of times we hear other reasons why people want to take Social Security early. And a lot of those reasons tend not to be related to the dollars and cents, but more emotional in nature. And so we're going to highlight 4 of those that we hear. And those are, one, it's out of my control. People are saying, well, it doesn't make a difference what I do, so I should take it now. Another one that I hear that's really common is, I don't know what's going to happen to Social Security in the future, but I know it's available to me now, and I should take it before something happens to Social Security. Another one that we hear is, well, I got to leave my job today, and I want to retire, and I'm getting my benefits as soon as possible. Or finally, another comment that we hear that's very common is, well, I don't know how long I'm going to live, and so therefore, since I don't know how long I'm going to live, I might as well take it now, because if I die early, then I'm not maximizing the Social Security benefit. In all 4 of those situations, we do think that the reality is much different than the perception of how people feel, and we would urge caution as well as discussion. Clearly, if someone has an illness where they know that they're going to be terminal within a short period of time, that's one thing. But otherwise, we really recommend that you talk to us and really think seriously before taking Social Security early based upon those reasons. So we want to talk about what are ways to maximize your Social Security benefits. And so we're going to give you kind of some just general guidelines and just some thoughts. So first of all, when you go to the Social Security office, I will tell you that the representatives of Social Security are great. They are really friendly. They are really helpful. Feedback that we've gotten from a number of clients who have worked with the Social Security office has been extremely positive in general. So again, good things to say. However, they are not able to give you advice. They are not allowed to give you advice, and even some of the suggestions that they may give as they're trying to give you the information may not necessarily be correct, which means that you need to come to the Social Security office with the knowledge already of what you want to do. You have to have a plan in place before walking into the Social Security office. The other thing is you need to think creatively. There may be benefits for you that is available that is not readily apparent simply based upon your working record or your spouse's working record. Finally, the rule of Social Security is you can only claim one Social Security benefit at a time. However, you can claim multiple Social Security benefits at different times. So that's really important as you keep in mind what social or whose Social Security you are claiming when, as you can't claim two Social Securities at the same time. The Social Security Department will disallow that. And that becomes really critical, particularly if you are considering taking Social Security early. So we're adapting this from the book Get What's Yours, which was actually on the New York Times bestseller list with regards to Social Security strategies, which simply indicates how important these issues are. And we thought that these three basic rules will get you most of the way there in terms of maximizing your Social Security benefit. So rule number one is be patient. As we showed you a few slides earlier, your best benefit of Social Security, the greatest benefit you receive is by waiting till age 70. And so be patient to wait to collect as you'll get higher benefits. Number two, get all the benefits that are available to you. So what do we mean by all the benefits? In other words, it's not only based on your work history, but it's based on the work history of your spouse, your ex-spouse, your deceased spouse, your deceased ex-spouse. So you want to make sure that you're getting all those benefits. And finally, you want to make sure that you're getting the timing right. As I discussed earlier, since you can't collect two benefits at once, that's you personally, you want to make sure that you are in a situation where you can collect someone else's benefit while watching your benefit grow. Now keep in mind that when we're talking about you can only collect one benefit at a time, that doesn't mean that multiple people can't collect on your benefit. So in other words, you could have a spouse and an ex-spouse both collecting on your benefit. So two people can claim on one benefit, but one person can't claim on two benefits at the same time. But he can claim on he can claim multiple benefits at different times.
So Seth mentioned very briefly some of the strategies that might be involved in the collection of Social Security benefits. What I'm going to do next is I'm going to talk about two very powerful but yet little known strategies for individuals out there. And those strategies are the file and suspend strategy and the restricted application. This is a little complicated, so what I would urge the listeners to do is, and I'm going to do the same thing here as I'm going through it, is to grab a piece of paper and a pen so we can do it together. And for the purpose of simplifying, I'm actually going to pick on Seth and his wife Michelle as we're going through this illustration. So let's figure out what the file and suspend strategy is all about. And as I mentioned, I'm going to pick on Seth and Michelle. So I'm writing the names, Seth and Michelle, on the whiteboard that I have right here. One spouse files for an application and immediately suspends for benefits. Again, I'm going to pick on Seth. So Seth is the one who is filing for an application and immediately suspends his benefits. Timeout. What does that mean? What that means is the following. And in my assumptions, I have the following assumptions. Both Seth and Michelle are 66 years old, and that is their full retirement age. So they're smart. They talked to their financial planner who recommended the file and suspend strategy in their particular case. So what Seth did is he went to the Social Security Administration and told them, hey guys, I know that I'm eligible to receive my checks right now. However, I do not want you to send me checks yet. I am suspending my benefits.
Which means I'm not receiving my benefit right now.
Sorry?
I'm not receiving my benefit.
Right. So right now, we're going to talk about the full retirement age. And again, everything is just hypothetical, but we're going to try and keep it as simple as possible. Right now, Seth's PIA at his full retirement age is $2,000 per month. Michelle's PIA, primary insurance amount per month is $1,500. So by Seth suspending his benefits and not receiving checks, he's basically allowing the other spouse, Michelle, to file for spousal benefits and receive checks on his earning record. So here is what's happening here. Michelle is now eligible at age 66 to receive half of Seth's $2,000 PIA amount starting now at age 66. So I'm writing down $1,000 a month from age 66 to age 70 that Michelle is eligible to receive. At the same time, Seth is basically enabling his own benefits to grow at a rate of 8% a year, which means that when Seth is 70 years old, his benefits are now 2640, 8% a year from $2,000. Let's keep going here. The next strategy is the restricted application. So we already talked about what we did thus far. Now we're talking about one spouse has filed for benefits but is yet to collect. The other spouse has an option to file for a restricted application. So here is what this is telling us. The spouse who applied for the 50%, in our case, Michelle, to receive benefits, so 50% off of Seth, remember that $1,000 a month, is now enabling her own benefit. And again, just to remember, her own PIA is $1,500 a month. She is enabling her own benefit to grow at a rate of 8% a year from age 66 to age 70. So basically, when Michelle turns 70, remember how at her full retirement age, she was eligible to receive $1,500 a month? Now at age 70, she's eligible to receive $1,980 a month. So the combination of benefits that Seth and Michelle are eligible to collect at age 70 is $4,620 a month. Now, this is why this is important. You probably go out and speak to friends who tell you, I'm so smart, I'm going to delay my benefits to age 70 because I have the 8% a year, and then I'm just going to start collecting my benefits. Well, that's wonderful, but without using those strategies that I just illustrated, you basically, or your friends are basically, have the potential of leaving some money on the table. In our case, remember Michelle collecting $1,000 a month from age 66 to age 70, that is $12,000 a year, multiplied by 4 years again for age 66 to age 70, $48,000 could have been left on the table if they didn't use those strategies described thus far. So keep in mind, I just talked about the combination of those strategies, and what I want you guys to glean from this specific slide is that we have 3 categories of when those strategies work best. I mentioned that both spouses have to be at their full retirement age. It cannot work if one is younger than 66 years old in our illustration. It also works best when both spouses are in similar ages, that goes without saying, and it also works best when both spouses have similar earning income. Again, in my illustration, Seth's PIA was $2,000, Michelle's PIA was $1,500, so that worked really well.
So are there times when couples may want to consider taking Social Security early? We spent a lot of time talking about the idea of being patient and waiting to take Social Security. And the truth of the matter is that Omer and I spent some time thinking about this, and the answer is yes. There are times that it does make sense to take Social Security early. And that's where we say that the information that we're giving you is guidelines, and there are specific other situations. So some examples would be you may want to take early in order to make an older spouse eligible for spousal benefits when they may not have earned the 40 credits of Social Security. You may have a disabled child at home that would be eligible for Social Security, so you may want to take Social Security early in order to have the disabled child have benefits. You may be a widow or widower, and you may want to take retirement benefits early in order that you can wait to take, until full retirement, to take survivor benefits. There may be another situation which came up recently in which you may have a child who is under age 18 and living at home with you, and that may make sense to have that child would be eligible for Social Security benefits. And again, so it's clearly not a one-size-fits-all, but there certainly are cases where taking Social Security early may make sense.
Okay, so we talked about the history of Social Security briefly. We mentioned its current status. We also talked about some of the strategies associated with Social Security. So now we have to talk about the future of Social Security, and this is when I want all the listeners to maybe have a cold beverage next to them and have a big smile on their face. And the reason why is because starting in 2033, the Social Security Administration will only be able to pay 75% of its benefits. Now, this is a problem. That being said, up until 2033, no harm is going to be done to those that are already grandfathered in and receiving Social Security benefits currently or will receive Social Security benefits in the next 10 to 15 years. Seth is going to talk more about some of the changes being offered.
We think there's a lot of ways that the government could improve the lifespan of Social Security or the full ability to make the Social Security payments. And some of those ideas are that they could change the full retirement age and increase it from 67 to age 70. They could lift the amount. Right now, the 6.2% is not being taxed on all earnings. It's only a portion. They could lift that cap so that more earnings or all earnings would be subject to Social Security tax. They could decrease the percentage we're delaying retirement credits. In other words, right now, if you delay each year from your full retirement age, it's 8% a year. They could drop that. The eligibility for starting Social Security could be increased from age 62 to age 64, or they could reduce the cost of living adjustment. In other words, the annual benefit increase in Social Security that you receive each year due to inflation. Any of those changes would significantly change the outlook for Social Security. Again, we do have tools that we use to analyze Social Security, and those tools that we use give multiple strategies so that you can determine what is the best way to, or what's the best strategy for you in your specific situation. And this just highlights multiple strategies that we have available. Again, because it's a webinar, obviously a recorded webinar, we don't have any questions. But we would like to thank you for listening in. We hope that this has been educational for you and gives you a little bit better understanding of some of the rules of Social Security, as well as strategies that are available to you in order for you to maximize your Social Security benefits.
And please come see us. Don't hesitate. If you have any questions or concerns, we're here for you.
Thank you very much.
Thank you.